Hi everyone, thanks for joining us today. Happy New Year. We wanted to do a quick recap of what happened in the fourth quarter of 2021, as well as what we see moving forward here in 2022 with rising inflation, as well as the Fed's raising interest rates as well throughout the year here in 2022 and 2023 and 2024. We're going to go ahead and jump in. We're going to hear it straight from our investment management team at AssetMark, from Kezia Samuel, Zoe Brenson, and Davin Gibbons.
I'm going to start with some highlights on what happened in the markets in the fourth quarter. So on the slide here, you see a variety of different investments. We're going to start with by taking our eye to the top. The fourth quarter had good results, specifically led by U.S. REITs. And this was as a result of the Omicron variant, which came back soaring in the last quarter, causing what I call is back to staying at home type of investments to come into vogue. As an example, in that REIT space, which is up 16.2%, we saw industrial REITs do really well. So think data centers, think cell phone towers, things that we all need to function, do very well in the fourth quarter, causing REITs to rise alongside the inflationary pressures that we saw. But the same Omicron pressure had a slightly different effect on the commodity complex. You can see with potentially all of us maybe staying at home a little longer, return to office being delayed, energy prices fell as a result of a lack of mobility due to the Omicron pressures, causing commodities to end in the negative for the quarter here. On the other hand, if you look at the global 60-40, despite all of the negative headlines, be it from inflationary pressures, supply chain disruptions, still up 3.8% for the quarter. Global equities also doing well, so let's just dive into that on the bottom left-hand side. Looking at the equity complex, the U.S. equities outperformed international equities, driven by strong corporate earnings. In fact, I'll hit on this as we talk about 2021, in that despite all the challenges, how companies have adapted in this environment have led to strong corporate earnings, as well as the stimulus that we continue to see driving some of the strong returns. S&P up 11% for the quarter, beating out its international peers. We also saw that Omicron caused international economies to shut down, thus causing developed international equities to trail relative to the U.S. peers. And last but not least, emerging market equities, again, struggling as a result of China having a zero COVID policy, those causing COVID disruptions, and thus leading emerging markets to the negative for the quarter. To close out the comments on the bond side for the quarter, here, because of Omicron, we did have interest rates fall ever so slightly, and that did lead to U.S. credit and core government bonds to have positive returns, very, very small, as you can see on the screen here. But what did do well and has continued to do well were the lower quality bonds, such as high yield, as investors have gone in searching for yield. Global bonds have struggled as inflationary pressures and rising interest rates, paired with the stronger dollar, has caused global bonds to struggle. So a bit of a tale of two cities, as you see here. Risk assets, despite headline risks, continuing to do well, but bonds, especially abroad, struggling. Let's take a look at 2021. I'm hoping that we can share some key nuggets as you think about doing your year-end reviews on how the broad investment landscape performed in 2021. 2021 was a year of big risk and big returns. There was no shortage of risks among the headlines, be it from rising inflation, supply chain disruption, the Great Resignation, to a variety of other things that certainly kept investors on edge. But at the same time, markets were able to look through these concerns and also balance those out with the positive, which is the rollout of the vaccine, in addition to massive fiscal as well as monetary stimulus. So let's take a look at how this environment's backdrop impacted returns. Looking at the top, with starting with US REITs taking the leaderboard here. We saw in the prior quarter much of those returns in REITs coming from the fourth quarter, up 41.3%. Just remarkable for the year. What caused this? Here's two interesting little nuggets that I saw in terms of what's driving the returns here. As US consumers, we certainly had the privilege of moving about a little bit more in 2021. So what did well within the REIT space were malls, regional malls doing the best in 2021. We all love our shopping. Guess what? We went all with that shopping. We needed to put it somewhere, storage units, also doing well. All of these underlying the improved mobility as well as reduced vacancy, driving REITs to be the number one on the leaderboard for 2021. Looking next, commodities, again, soaring energy prices as all of us began our mobility, wanted to travel, causing energy prices to soar, leading commodities to also post strong positive returns in an inflationary environment as well. But a little interesting nugget, within the commodity complex, most things did well with the exception of gold. Gold fell 4% in 2021 despite inflationary fears. And we've written about this in that gold has a mixed relationship with inflation. Instead, gold has a more direct relationship with how the dollar performs. When the dollar does well, gold tends to fall, and that is exactly what we saw happen in 2021. The dollar was strong, causing gold to fall. Nonetheless, commodities broadly have done well in this inflationary environment. On the other hand, we saw global bonds on the far right-hand side struggle as interest rates rose, as well as the strong dollar causing global bonds to fall. So sort of a double whammy for global bonds. So now let's take a look inside the stock market on the bottom left-hand side. First thing, the US stock market had a stellar return, outpacing and outperforming its international peers. What drove those returns? The US equities up 28.7%, strong corporate earnings. In fact, corporate earnings grew 45% year over year. In doing that 28%, nearly 29% returns, it did 70 new record highs during the year. And this is the second best year after 1995 when we saw 77 all-time record highs. It's just hard to fathom that with all of the risks that we face, the stock markets look beyond those headline risks to post these strong returns. And let's not forget, this is the third consecutive year that we've had double-digit gains. 2019, 2020, and then 2021 on the heels, all of these strong double-digit returns. Looking abroad, international developed, these are stocks in Europe, they did well. In fact, in local currency terms, developed international equities were up 19.2%. But because of that stronger dollar, as you bought back to the US dollars, we lost some grounds and it's up 11% or so in dollar terms. So do know that the strong dollar did have a significant impact on developed international equity returns in 2021. We also saw emerging markets continue to struggle as led by China, which again had a zero COVID policy causing disruptions in their economy, as well as several regulatory changes as they adapt to a new environment, all leading Chinese equities to fall and emerging markets to fall down 2%. This gap, in fact, between US and emerging markets has led to the widest gap between US and emerging markets in 23 years. So do note that this is a significant anomalous scenario looking at those two complexes. Finally, rounding out the bond conversation on the bottom right-hand side, no surprise, rising interest rates did weigh on bonds, global bonds taking the worst of the drop, down 4.7%. But there were two silver linings. One is shown on the slide here, which is lower quality bonds as investors leaned in to look for yields, so high yield doing well, 5.3%, but also tips that are not shown on this slide rose 6% for the year, given the fact that inflation expectations rose faster than anticipated. So quite the dynamic here, as Zoe mentioned earlier. Stocks and risk assets doing really well, even despite all of the risk headlines, but bonds struggling in an environment where interest rates rose.
So I think you said it nicely there at the end, Kezia. Risk assets was really the place to be, not only on the equity side, but also the bond side, and having equity sensitivity really helped lift returns. So let's start looking under the hood a little bit more, because I know there's some differences and variations across the sectors and the styles in both the equity and the bond markets, Kezia.
Indeed. So let's dive into the stock markets. And on the left-hand side, we're going to look at the sectors, and then we'll look at size and style to see what did well. Looking at the sectors, we're going to look at the year-to-date. On the year-to-date, for the first time, all sectors had double-digit gains since 1995. So we're going in and setting stellar records. What type of sectors did well in 2021? We found that in the sectors with a cyclical weight, so energy up 54%. Similarly, real estate tied to that cycle of the economy did well, rounding out with financials as well as technology. Those were the leaders in 2021. On the other hand, defensive sectors like utilities and consumer staples, and maybe Zoe, we talked about consumer staples doing well in 2020 because of the toilet paper run. Maybe we just all bought way too many toilet paper rolls in 2020 and didn't need as many, and had a relative underperformance compared to the earlier ones that I mentioned. Nonetheless, up 18 and 19% respectively, even for the defensive sector. So that's what we saw on the sector side of things. On the right-hand side, when we look at size and style, what we found was that value-oriented segments did better outside of the mega cap names. So if you look outside of large cap, mid and small cap value outperformed its growth peers not just for the year, but also mid and small cap value outperformed large value for the year as well. Within the large cap space, because of the concentration in returns between a few mega cap technology names, large growth outperformed value. So that's what we saw, a bit of a rotation, in fact, from what we saw in 2020. Let's do the same exercise in the bond side of the market, looking inside the US bond market. On the fourth quarter, I mentioned interest rates did fall on the heels of Omicron fear, causing longer bonds to benefit, but it wasn't enough to reverse the earlier losses that came through for the year to date. As you can see, any interest rate sensitive bonds, the longer your interest rate sensitivity or duration, the greater the pain that was felt. Long bonds suffering the greatest in for 2021. And again, the lower quality bonds, as investors have been searching for yield, tending to do well, alongside tips, as I mentioned, which is not shown in this slide here, also up 6%. So that gives us a snapshot of what happened inside the sector in the US markets as well as in the bond market, Zoe.
Great. Now, Kezia, we've mentioned a few times how phenomenal that return was for the US equity market, up a whopping 28.7% return in the third year of double-digit returns. But a lot of investors may not know the concentration that's really been driving to it. And you mentioned that just as we walked through the growth conversation. So what can you share with us about kind of the drivers of the S&P 500 and the concentration that we've seen there?
Yeah, and I think, when you look at the surface, it's hard to think that there were any hidden risks potentially. Who's going to complain in a year where you have nearly 29% returns in the S&P 500? But what you see when you look under the hood is that the returns didn't come very evenly. And we've seen this story play out in 2020, and we've seen some of this play out again in 2021. So let's take a look. On the left-hand side, we know that the S&P 500 is a market cap weighted index, in that not all 500 stocks get an equal weight. The bigger the stock, the bigger the chunk in the index, and the bigger the driver of performance. So if you look at the top 10 stocks in the S&P 500, its weight has risen to a record high in 2021 to now sit at 30.5%. So just 10 stocks making up nearly 31% of the entire stock market's market cap. In addition, if you think about where we come from 2015, the S&P's top 10 stocks were roughly 16%. So we've nearly doubled since 2015. So just to provide some perspective, this concentration has caused returns to also be fairly narrow. Take a look on the right-hand side. The top 10 stocks in 2021 delivered 2/3 of all the returns. So if you look at the price returns, take out the dividends for a second. The S&P was up 27%. Of those 27%, 19% of it came from just 10 stocks. That's 67% of the total return. The balance 8% came from the other 490 stocks. So what does this mean for investors? First, just note that unless you're passively invested through an ETF, if you owned a basket of stocks that did not replicate just these 10, likely your return differences are going to be varied based on what you may see on CNBC or whatever your source of news headlines. So that's the first one. Second, this creates opportunities, right? This is not a way just to look at the risk, but also to find opportunities. And then David's going to hit later on how the dispersion between the top and the bottom creates opportunity for investors to pick up things on sale. I'm a girl that likes to buy things on sale. You can find things on sale, but you just have to look under the hood. You can't simply look at the surface. I want to share one other slide as well, which is, when you see a year like 2021 with whopping returns of 29%, you think surely everything must be up, but that's not the case. What we've done on this slide here is taken the S&P 500 and broken it up based on their returns. You can see gains ranging from 100+% all the way down to losses of 20 or more. And what you'll see is that not all stocks were positive. First of all, there were around 62 stocks in the S&P 500 in 2021 that had negative returns, despite the S&P 500 having strong returns on the headline basis. So that's the first one. The second note is that, in the S&P, we had a fairly benign year, no volatility. The deepest drawdown we saw was 5.2% during the third quarter. But if you look underneath the hood, Zoe, 93% of the S&P 500 stocks had a 10% drawdown or greater. In fact, the median drawdown was 20%. So when you look underneath the surface, what you do find is that corrections were very much part of the broad equity markets, except the concentration or the nature of the S&P 500 index was hiding some of this volatility at the surface level, providing, again, lots of opportunities if we're willing to do a little bit of extra work. So hopefully giving you a little bit more nuggets than what one may be reading on just the headline great stellar returns. There was some deeper things and deeper risks that investors should be aware of.
Kezia, I think kind of as I think about it in simple summation, it was a great year for the US equities and REITs. It was a tough year for bonds and for emerging markets. But we really need to think about that US equity return and dig into it a little bit more, because it wasn't even. Active management, as you said, unless you're in those top 10 stocks, you probably had a tough time keeping up with the markets. And at the end of the day, is 10 stocks really a diversified portfolio when you think about an index? So just some things to think about in the back of our minds as we're talking about diversification and more broadly diversified portfolios. So with 2021 in the bag, let us move into 2022. And David, let's think about the economy and its impact for other investment considerations. And I think about 2022 and where we're going, and I think about where we've been. We may have been in a case where economic growth has potentially peaked. We've seen inflation at significantly higher levels than we've seen in a very long time. And we've seen the Fed starting to take their foot off the gas pedal. I wouldn't say they've pumped the brakes, but they've definitely been taking that gas off with the tapering. So what are we seeing as it relates to both the market sentiment and consumer sentiment as it relates to the economy?
Sure, thanks, Zoe, and hello everyone, and Happy New Year. So I wanted to start off on this chart with a look at Zoe said the growth outlook. And on the left-hand side, always a big fan of leading economic indicators. Always try and remember that markets lead the economy, so we want to try and focus on that segment of the marketplace that looks ahead. And as we can see in this left-hand chart, the Conference Board's leading economic index has a really solid relationship with leading recessions, which is the vertical gray lines there on the left-hand side. And it's a variable time frame. It can be maybe 7 months, 21 months, 15 months, what have you. But I think the really important thing to take away here is currently you can see that this index is making new highs, and it is fairly broad-based. It is a composite of roughly 10 indicators. think building permits, unemployment claims, that sort of thing. And it tends to be, it's being very broad-based right now. So from this chart and this graph, what we're seeing is that currently the environment for, I'd say, equity markets, it remains quite supportive. However, flip side of that, when you look on the right-hand side, you say, oh my goodness, so we've got here another conference board chart, and it's a survey of consumer expectations versus the present situation index. And what it shows is that the expectations for the future are really much more sanguine and down than they are versus the present. And you can think to yourself, well, boy, oh boy, that doesn't look very good. If you look back in history, this kind of movement tends to precede some pretty severe recessions. And my point there is, well, yes, that's true, but also these kind of very low readings also tend, when they happen during recessions, they tend to happen around the bottom, quite frankly. And remember that markets tend to bottom during recessions, so it's kind of a weird dynamic. And I think a lot of this can be laid at the feet of probably inflationary concerns, if you will. People are, they're seeing this every day at the gas pump. They're seeing it in the stores with the shelves that aren't stocked. So it'd be quite interesting to see how this plays out. Because I think we have an environment that's currently supportive for equity markets, but people are very, very concerned about the future. And I think this also goes to Zoe's point about sentiment. And if the economic sentiment starts to pick up a little bit, we might see once again an environment that could be very, very good for equities going forward. Well, I mentioned inflation a little bit, and here I also want to pick up on a theme from the last slide, contrasting the current outlook versus the future outlook. And on the left-hand side, we have a chart of an implied inflation from the TIPS market across a number of different maturities, going from 1 year out to 30 years. And what we can see is that over time, the expectation for inflation is gradually it's being wound down at roughly the 3.5% or so in the near years, versus down to less than the 2.5%, 2.6% over the much longer term. So definitely the expectation is that inflation will subside over time, but more than likely remain above where we've been used to, say, in the 2010 decade. And on the right-hand side, we can see consumers are again, they're not necessarily sharing the same sort of sanguine outlook. Here, although we are expecting, and this is a survey from the New York Fed, that the 3-year expectations for inflation are expected to be lower than what's happening over the next year. It's still up in the 4% range. So again, here we have this dynamic of consumers expecting maybe inflation to be elevated, and that's what's probably maybe feeding into some of their sentiment. But again, the expectation is for inflation to subside from current levels, but again, remain above where we've seen it and been used to for certainly the last 10 or 20 years.
So David, as you mentioned about the inflation, we've also seen a shift in the Fed tone. As it relates to inflation, they've now dropped transitory as part of its description. So what should we expect from them for the remainder of 2022 with regards to the tapering that's going on, the hikes that might potentially happen? And if we do continue to see this higher level of inflation, what does that mean for our portfolios? How are ways that we can help protect portfolios, for lack of a better word, in this higher inflationary environment?
Sure, thanks, Zoe. And I think that's really been the story so far of 2022, has been the Fed speak, if you will. They came out after the December 15th meeting and made quite clear that they were going to be undergoing a more hawkish shift in policy. Their view of employment was quite healthy, and that their expectation for inflation was going to be slightly increased. So given that, they really announced 2 things to the public. First one is that they're going to be accelerating the pace of their tapering program. That is that they were going to be gradually winding down the bond buying program that was roughly, I think 30 billion a month, and they're going to be winding it down to 0 by March. And that's a very large deal. To be clear, though, about tapering is that it's still adding to the size of the balance sheet, just not adding as quick as it was initially. The second thing they did was they pulled forward their expectation for interest rate increases. Previously at the November meeting, they were expecting 1 rate increase in 2022, for example. Well, they pulled it forward and now they expect 3 in 2022. And on this chart here, it shows, well, it's not just the Fed that was expecting now 3 increases in 2022, it's also the Fed fund futures or the market pricing. So that was after the December meeting. Now, so far this year, the other dynamic that's come into place that's caused rates to rise a little bit more and cause a bit more volatility in the markets over the last few days is that they also started to initiate and have initial discussions about reducing the size of their balance sheet. That is, when bonds mature, instead of reinvesting, starting to let the assets run off. So it's those 3 forms of reduction in accommodation. Taper going away faster, higher interest rates sooner, as well as the idea of maybe some bond buying runoff. That's really caused people to think, well, the Fed is also taking this inflation story very seriously, and that they might be taking their foot off put their foot off the gas pedal quicker than the people had otherwise thought. Now, long term on this chart, I just want to point out they have maintained their expectation for a 2.5% Fed funds rate. And that sort of remains to be seen over time. That peak in Fed funds rate with the cycle has gradually been coming down. It was 6.5% in 2000, 5% in 2007. It just got to 2.5% when Chairman Powell turned around in late 2018. So it remains to be seen whether we'll get there, especially given the level of indebtedness that's been put on the federal balance sheet since then. But for now, they're maintaining this longer rate. But all said, the Fed has really been front and center so far in market action in 2022. And as Zoe said, part of the reason for that is this notion that, well, we don't think that, I think Chairman Powell said, let's retire the word transitory when it comes to talking about inflation. And on this chart, what it shows really is that we need to take a more granular look at this. The chart on the left shows that since 1970, inflation is not necessarily bad. It's when it gets into the tails, when it becomes higher than people, and it stays higher for a while, or when we get into that deflationary period, so it was in 2008, that's when it tends to take on things like earnings and margins and so on. So if the Fed is right and we're going to be gradually moving away from this higher inflation period, and some of the things in 2022 are going to gradually run off, then it may be that we end up more in this happy middle range where it's equities can enjoy fairly solid returns over time, and the bond market may not necessarily suffer as greatly as certainly as we've seen on the far right, where inflation was over 6%. On the right-hand side, it shows that not every single asset class responds in the same way to inflation. It's the inflation beta. And so not surprisingly, when we get a 1% rise in inflation, it's the more inflation-sensitive asset classes that you expect, commodities, natural resources, REITs, they tend to do quite well. And it's the more anti-inflation plays, the bonds down at the bottom, that tend to do a little bit worse. But then once we get into the middle, we're seeing some things under the hood that are interesting. International equities tend to do a little bit better when inflation is a little bit higher. Small cap, more cyclical type stocks, U.S. value, all these things tend to do a little bit better and actually have a reasonable beta to when inflation is rising. And I think that's important to remember. We're going down to the bottom. I want to pick up on gold just a little bit to Casey's point that it's really more sensitive to the dollar. So if you want an inflation hedge, assuming it's not the far right-hand tail of the 6%, 7% over a sustained period of time, you might be better off picking up some of that earnings yield that's in things like international equities and small caps and so on.
Great. And just to be clear for everybody, that left hand, if you can just go back a slide, David, just to kind of be clear, because I just noticed that the key on the left is missing. Those light blue bars are the bond market. the dark blue being the equities and the light blue being the bond market. So apologies for missing that bit of the key, but just for everyone's awareness what that is. So we just mentioned here, David, kind of equities will help with inflation. But given they're pretty rich right now and the valuations are pretty high, is there still place for them to kind of help provide that protection? And while on the subject of valuation, we haven't considered that as part of our bond discussion yet. We know credit spreads are really tight. So how should we be thinking about equities and bonds in our portfolios given valuations are so high?
Sure thing. So the first thing I always like to remind folks of is that valuations, although very important, they tend to be good for long-term indications, but over the near term, 1-2 years, it's much more of an inexact science. There it becomes more about environment and other things. And the chart here on the left-hand side, harkens back to something that Kezia was mentioning. With all the concentration in the top 10 names, that shaded area shows the valuation dispersion between names. And when it gets to be quite wide like it is, what it's really showing is as people have gravitated to and bid up those 10 names, there's really rich opportunity for some of those names that have been left behind. They're much more attractive from an absolute valuation perspective. And sort of here what you can see is, based certainly on long-term averages, valuation dispersion and those opportunities for active management and selectivity are really quite robust in the current environment. And on the right-hand chart, one of the ways this was played out in that the international stocks have really been left behind again. And here what we can see is that the relative valuation of international equities relative to the U.S. is as cheap as we can remember in the last certainly 20 years or more. So if you've got this valuation dispersion going on, many international names have been left behind. If they look relatively cheap, certainly to the top 10 names in the U.S., I think there's opportunity in portfolios maybe to lean into some of these international names from a valuation perspective. Now, there's other things that are going on more near term, like economies and so on, but certainly the opportunity there remains as rich as it's been certainly over the last couple of decades. With regards to fixed income, it's a bifurcated look at it. The chart on the left, I like this expression of a shield and yield. When markets go down, I'd say fixed income and core fixed income, things like treasuries and so on, they remain really a solid ballast in the portfolios, and they can provide that buffer when equity markets are going through volatility. And that role for fixed income has not gone away, even at these low yields. That said, there is also the opportunity for additional yield from spread product, things like preferreds, high yield, and emerging market. However, those come with a cost. They're a little bit more volatile, and they're more correlated with equity market movements. So again, there's if you can find the right balance between the two, I think there is a play to add some value within fixed income without just, say, running to cash, for example. That said, on the right-hand side, just like equities, there is some valuation concerns here. The high yields and other things, certainly relatively expensive, looking over their last 15 years. So, don't go into blinders on. There are some risks here, especially with the equity markets. But again, if you can dip your toe towards these within fixed income, there is certainly a yield advantage there over the next little while. And that's why, if you think back to the initial slides about the economic environment, if it is currently still supportive for equity markets, as it appears to be, there's some sort of scant signs of recession, then certainly sticking with this yield pickup in some way, shape, or form within the fixed income makes sense. And finally, taking a look at the portfolio as a whole. Given last year was so strong, and in particular parts of the market were so strong, the top 10 names, as Kezia pointed out. Sometimes it's very easy that we want to chase the winners and avoid the not so winners. And what this chart shows is that if you stick with last year's winners, over the next year, you tend to underperform over the long run. And if you actually switched into last year's secondhand or ones that don't do as well, they tend to come back over time, that valuation argument. However, there can be some near-term risk involved in some of those names that have been left behind. So that's why really keeping some sort of a balance within your outlook remains as important as ever, especially when we've had such a bifurcated market as last year, and you're wondering what the Fed is going to do, and never mind what Omicron may do to the economic data over the next month or so, or what concerns there might be for midterm elections down the road. So there's a lot to be thinking of here in 2022. I'll stick with the environment for now, despite some higher valuation, remains favorable, and I favor such a balanced approach going forward.
Great, thanks, David. So as I think about it, in summary, you're really telling us to be balanced and be disciplined in our investment processes, and to make sure that we've got exposure that can help benefit if things are straight up, but also help protect us if things do get a little twisted. So remember that, folks, balance and discipline within our portfolios. Now, we've heard a lot of information today, and before I get into the key takeaways, just a reminder that if you have questions, we've seen a few come through, please submit them through the Q&A box. But let me try to summarize some of the key points that we've heard today. Now, on the S&P 500, we've seen 70 new highs in the US markets, and they've really led equities. But as we heard from Casey, it was really just a handful of stocks that led that market return. Bonds have had their third worst calendar year since 1976, so quite a phenomena there. But there were a couple of bright spots in the bond markets. Casey highlighted tips as a result of the inflation being higher and surprises there, and then high yield and their equity sensitivity, and the fact that they're less sensitive to rising rates. So a couple of bright spots, but overall, bonds had a really tough time. The cream of the crop, though, commodities and REITs. Buoyed by the higher inflation, we saw that they're very inflation sensitive from their inflation betas, and that's really helped lift their returns. And as Kezia said, we all like to go shop, especially when we haven't shopped for over a year. And so malls really helped lift some of those returns. So that was what we saw on the market side. If we turn our attention over to the economic side, we've seen that heard from David that we expect to see growth, and we expect it might be at a slower pace, but remember that a slower pace is not a negative pace, or no growth. So we expect there to be continued growth as we go forward. We also have seen the comments around inflation. We do believe it's going to be inflated and above that 2% target that the Fed has held out for so long. We know there are supply and demand imbalances today, and they're going to normalize a little bit, but there'll be other drivers that might keep us a little higher over that long term. So just a reminder that we're going to be at probably higher levels of inflation than we've seen in prior years. And then, as we mentioned, within portfolios, it's about selectivity. We know valuations are rich on the equity side and the bond side. So it's about that active management, making sure we can be really selective in terms of the securities and the credits, and overall to remember to be balanced. While we know rising rates are not great for equity markets, we know for bond markets, and especially long-term treasuries, we know long-term treasuries are the only place that really provide us safety if the equity market falls apart. So while we might not want any kind of core and traditional treasury exposure in our portfolios, as we highlighted here, we still need to have some of that shield because we don't know what's coming around the corner. We want to make sure we're balanced, but tilting the portfolio appropriately. So just a summary, and before we get to the Q&A,
All right, there we have it. Very good recap from our asset management team at AssetMark. from Zoe, Kezia, and Davin as well. And just to echo some points from the end there with Zoe on the recap, we're going to see some growth moving forward here long term. Very important to remain disciplined and balanced. And as always, if anyone has any questions, please feel free to call us. Want to thank everyone for watching. Have a wonderful day.